What's up, Outliers? Happy Friday, happy Thanksgiving. I hope everybody is having a super fun trading week. Today was a little weird because the CME had some issues, which had futures trading closed for a bit. I feel like some of them were just like, yeah, we don't really feel like working today. But we are here all the same. So before we get too far in the weeds, I want to give a shout out to those that are here hanging out. And I see Lauren, we got Brain, we got Michael. Good to see everybody. I see Kirk. Awesome to have the gang in town today. Reese, good to see you as well. Familiar name, obviously. And today is a extension of the latest mini series, which will be the last one of this year before we have our next mini series kickoff, which will be in 2026. And this mini series was not holistic, but designed to tackle a lot of very basic concepts with respect to trading and to shine a lens on them. So things like how to take an idea that you might have and turn it into a trade. Things like how to actually create and iterate on your edge. Things like that. And I think a little more broadly, when we think about trading, most of what we do falls into a couple broad process categories. And what I want to talk about is what some of those broad processes are and how we actually get better at them. You will have heard me talk about a lot this idea of like focusing more so on the process versus the outcome of individual trades. And obviously, like I am such a firm believer of that. This session today, we have three things on the docket. We're going to go over this little quiz that I have up on the screen for you. This is just pulling together some broader concepts that we've talked about at, again, like a really simple level, like nothing in here is too crazy, but designed just to get the brain working a little bit. Then after that, I want to talk about like where I think it makes sense for people to go next in terms of like what to focus on. And then at the end, we have time for just a generalized open Q&A. So the purpose for that is I try to set time aside for us to have like a broader conversation, whether it's pertaining to some of the stuff that we covered in the course, whether it's stuff not in the course, whether you're curious what kind of books might be good to read, whether you want to explore different methodologies to creating wealth that isn't relegated to trading. It's kind of open ended in that way. So here we go. The first thing here, it says, if you want to buy a call, what is most important? We have implied volatility is option A, price movement is option B, and time is option C. So throw in the chat which letter you think is the correct answer. Is it A, B, or C? I see B. I see B again. I see B. Lauren says all but B. B. Okay. So I don't think I tricked anybody here. This is good. The reason why I threw this question in is because a lot of times you will hear things like don't buy options if volatility is high, or don't buy options if implied volatility percentile is high. And in a nutshell, that is entirely wrong. And it's because we can find instances where something might actually have a high IV, you buy a high IV, and then you end up getting a subsequent move that you want. So let's explore that concept really, really quick. Let's just find some stuff that has a pretty high IV. We'll go into the platform really quick, just be a little easier to find stuff with high IV in here. All I'm going to do is, again, look for stuff. That one's VRP, which is okay. Let's take a look at implied volatility percentile. All I'm doing here is I'm looking for stuff that has high implied volatility percentile. And we're looking at stuff that has weekly options. Most of these have earnings of some sort, IAU. This is great. This has an 87% implied volatility percentile, IAU here, which is a gold ETF. And if we take a look at what the volatility in here looks like in IAU, and we just chart out super quick what the percentiles look like for these longer duration, midterm duration options. And I see stuff in here that's like from the 20th, 30-day options were at the 80% implied volatility percentile, 80%. So it means implied volatility was high. Let's take a look at what the raw vol was on the 20th. On the 20th, raw vol was 21, and it dipped down to a low of 19.8. So it dipped down 2 points. Here's what you've been told, that if you see something like this that has high implied volatility percentile, you shouldn't buy options in here. The other thing that you're told and systematically overemphasize is trying to get cheap vol and not paying enough attention to the direction. So let's take a look at what happened here. In this scenario, volatility declined by like 2 points. Let me get paint so that we can track this. Actually, no, we'll just use, let's instead use this. What I want to do is literally track some of this with you so that we can take a look at the scenario. So here, implied vol in the beginning was like 21.6% or something, and then it dropped to 19.8% or so. So in terms of what volatility has done, volatility has declined by like 1.8%. However, this corresponds to like an 80% implied volatility percentile. Now, let's take a look at what price has done over this corresponding time frame. And all I'm doing is, again, I'm using the price movement from that corresponds with this move in vol, and I'll get rid of the extra stuff so you can see what I'm doing. I'm starting when vol was kind of high, like a few days ago. Let's go here when it was 23% on the 19th. So on the 19th, it was 23%. And then if we take a look on the low here, it's like 19.6 on the 25th. So then if we go 25 node, it was like 19.6. So this is what vol did over that time frame. And let's take a look at what price did. What I want you to pay attention to is the difference in what you've been told. Again, what you've been told is you shouldn't buy this vol because implied volatility percentile is high. And I want to be clear that in and of itself isn't a bad general way to think about it. You don't want to overpay for stuff, especially systemically. It just stacks the cards against you. But let's say that for whatever reason in here you had some sort of stronger directional thesis. So let's take a look. So on the 19th, price was, I'll take the midpoint. So it was like 77. So spot price was 77. And then let's take a look on the 25th. The midpoint was 77.90-ish, something like that. 77.90. So here you got a 0.9 point move against a 3.4% move in terms of vol. Now, depending on what kind of options you had, this could either be a profitable move or it could be a completely not profitable move. It's really because this thing hasn't moved a whole lot. Yet, if we take a look at what damage this did, it really depends on what options you chose. Now, again, we're using 30-day options for this example. So let's take a look at what 30-day options look like right now. And we just want to get a sense of what the general vol might be that we're dealing with. So we'll go here to 28 days. We'll go to something that's at the money. Your Vega here is 0.087. So let's go back to our document. Your Vega is 0.087. And your delta there was 0.53. Let's see what happened here. We moved 90 cents. So what that means is you don't get this full delta move, but you get some of it. In terms of delta, you got 48 cents in terms of your P&L. Here, we moved 3.4 points. In terms of your Vega, you got effectively 30 cents of Vega moving against you. So with that 30-day at the money option, modeling off of current price, even though volatility declined, and even though it certainly did not go in your favor, you still are in the scenario where the trade itself isn't unprofitable. That is probably one of the most overlooked aspects when we're looking at pricing and when we're looking at what kind of options we may or may not want to select. So the main thing to pay attention to here is that just because you see volatility is elevated, that does not mean that you can't buy options and that you can't make some sort of profit on your options. Okay. Any questions on this first question, which is if you want to buy a call, what's most important? What ends up being most important for the long call scenario is if the underlying moves in the direction you want. That's ultimately what matters and what matters most. All right, let me see what you guys got. So it looks like everybody was on the same page with B. I see, shouldn't it be delta? No, it doesn't have to be delta. So price movement is what matters. Delta is just a measurement. I wouldn't get those two confused. Delta tells us the rate of change of premium per point move in the underlying. That isn't the same as what the underlying is actually doing itself. So you can have something that's a 50 delta, or you can have something that has some sort of delta, but that doesn't mean that the underlying moves. Now I understand the inference that you're making, but it's a little bit different. And then Black Mama says, why not GLD? I literally just ran a scan to see what had high vol and pick something that had high implied volatility percentile. Okay, cool. I'm going to give you guys a couple seconds. I'm going to grab a drink really quick, but I want you to answer number 2 in the chat. So number 2 says, if you sell a straddle, price remains relatively flat. IV contracts slightly, but you still lose money. What might be the reason? So take your best guess, and then I will join back in just a sec. All right, let's see what we got. I see Black Mamba says if the loss from the price is larger than the profit you made from time passing theta and a drop in vol vega, the position will show a net loss. Good. Kirk says RV greater than IV. Good. Reese says realized over implied. Good. Black Mama says a short straddle creates a tent-shaped profit zone. Yep, so you're talking about a risk profile. It makes money from time decay and dropping vol. Good. That's all really, really good. You guys did a good job. Brain says gamma, not quite. Genesis says realize vol plus friction, so free fees, which is also fair. The thing that I wanted to explain here is the way that price moves has a really, really important impact on the way that your position behaves, even if you think things haven't done a lot, it still can be enough to move vol. And I'm going to grab paint and I'm going to draw you guys an Eric special. So let's take a look. Here's what I'm talking about. If we have a stock chart and if price is relatively flat, right? Let's just say that it's kind of oscillating sideways in this consolidation. Just because price is oscillating sideways, it doesn't mean that the pricing between IV and realized vol is profitable. You certainly can, albeit unlikely, have a scenario where price oscillates sideways and your move here is enough for realized vol to exceed what was originally implied. Now, there's a massive caveat to this question, and I'm curious who will be able to understand this caveat. Let's say that the option at this point here, let's say halfway, oh shit, let's say halfway through the life cycle, let's say that's where the scenario we just looked at came to fruition. Okay. So this is about like 50% throughout the life cycle of the option. And let's say that your upper strike is here and your lower strike is here, just to pick something random. Now, here you can see an unrealized loss. If this undulation motion is enough to cause an imbalance between the implied expectation and realized. Where things get interesting is who can answer this follow-on question. If we get to expiration at this point, would your option be profitable, P for profitable, or L for loss? Would you make or lose money? Just throw in the chat a P if you think it would be profitable, and throw in an L if you think it would be a loss. This is, I think, easy, but some people can kind of psych themselves out with what we're looking at. Okay, so everybody says profitable. Good. That highlights a really, really important relationship, because at the end of the day, if spot price falls between your short call and your short put, regardless of how it looked along the way, it's still profitable, period. Even if it had a net loss. This concept, again, pretty clear, but is really, really important to understand because let's say, for example, we get rid of this scenario and instead, let's say that you're trading a short call. So you want to sell a call. Well, again, somebody might tell you, well, hey, you only should do this if vol is high. And why would they say that? Well, because you collect more premium, and a lot of times they're also playing the intent for IV to contract. Yet, let's say that this short call is a covered call, meaning you have long shares that this thing is being sold against. Why does that make such a big difference? Because in terms of the premium you collect, sure, you would prefer to have more premium than less premium, but you already have the long stock position. So if you already have the long stock position and if the premium is low, that might not mean that you just don't sell the premium because the premium's low. It might mean that you might not make as much on your premium, but you still have the long shares. So you have a choice between collecting a lower premium or collecting no premium. Because if you choose not to sell, you get nothing. That's the first thing. The second thing is even if, let's say, implied volatility expands. So if vol is low, the fear is that implied volatility might expand. Well, that just goes back to the example we were just looking at, right? If we're in here and let's say our short call is here, and let's say you sell at this point right here. And then let's say after this point, price starts to move up a lot. Well, this will cause an unrealized loss. But if price stays below here and we get to expiration, you still made money, even though this scenario occurred. The other scenario is, let's say that for whatever reason, the pretend that this chart now is no longer price. Pretend that this chart is actually volatility. So I'm going to plot volatility. The difference is, even if volatility skyrockets and you're experiencing an unrealized loss, as long as price stays below this level, you still, at expiration, have a profit. This is really important because what you will find is very regularly traders will over optimize for the wrong stuff. They won't sell the call if they think vol is too low. Meanwhile, if you don't sell the call, you get no premium. The other thing is that a lot of times they're not paying enough attention to the total life cycle of the position as it pertains to their broader position. So that is going off of this idea and this relationship between intermittent changes in vol impact to your P&L and understanding how to use that information to make better decisions about your own trades. Black Mamba says the probability for profit more important than high IV to determine if premium worth it. I would fully disagree. I don't think the probability of profit actually matters effectively much at all. And it's because the probability of profit is looking at a bit of a different scenario. For example, you can have some sort of probability of profit metric that would be a what you're looking for, right? Let's say that you want a 70% probability of profit and you sell that option at a 70% probability of profit. I would argue in the context of a covered call that's actually also optimizing for the wrong thing. I would argue that the dominant force in a covered call first comes down to your inventory preference. That I think is super, super important because, like you said in your second comment there, scale the highest probability. Well, if we wanted to sell a call with the highest probability of profit, since we're here in IAU, we're going to be out here. We're going to be out as far out of the money as you can go. That's where your probability of profit is the highest. The issue with that is you don't collect really any money for it. So then, sure, you'll win the majority of instances, but you're not really getting anything to do it, which is exactly why, more often than not, when we're trying to collect some sort of credit for our long shares, we would look for something that's at a balance between our inventory preference, which means the probability that we get challenged or the option falls in the money, against how much money we're making. And there's a bit of a delicate balance in that. This, I'm also realizing for some reason, is missing a ton of names. Why is that? Open interest. That is super weird. Because this is missing a ton of names in this scan. I just realized. Hey, what's up, Goofy? Good to see you. Let me take a look at one other version. Because that's kind of problematic. It shouldn't be that limited. And I can't tell if it's this IV percentile. Let's take a look at option. Let's see. So I see implied vol, and I don't see an IV rank. Let's drop this really quick. So, let's get rid of this range filter. Hopefully this gives us a bigger list. There we go. Way better. Okay, cool. So it's just that other tool, the trading range filter, does a bit of a different function. So yeah, okay, good. This is better. This is what I would expect to see. And I see a bunch of individual names. All right. The other thing is the implied volatility percentile here differs from the look back period here a little bit, which is a little bit annoying, but again, that's the nature of using this platform for stuff like this. It's kind of annoying, to be honest. But the other way to look for stuff in here, in case you're wondering, is just to use their standard implied volatility. The problem with their implied volatility rank is their IV rank has a series of issues. And it's because their implied volatility percentile is actually IV rank. So if you use that, just make sure you're aware of that. So for example, if we grab IV percentile and we want stuff that's at least 30% IVP up to 100, and we run this scan for it, you're going to get a bit of a mixed bag. And the reason why you're going to get a mixed bag is because a lot of these things will have a different implied volatility percentile versus IV rank. And let's just take a quick look at an example so that you understand what I'm saying. So we have WULF. So let's go to WULF. If we look in here, you can see that the implied volatility percentile is actually 32%, whereas the implied volatility rank is all the way up at 60. This is a really commonly messed up metric between these two tools, and Thinkorswim unfortunately gets this like pretty wrong, which is, again, it's unfortunate because in general we would much prefer to use some sort of like actual implied volatility percentile metric versus using standard implied volatility rank. Implied volatility percentile is way more accurate. Now, quick cliff notes. If I were to actually trade some sort of vol, I wouldn't be looking up to 100%. I would be somewhere in kind of like this middle zone. And that's because that's where the vol edge tends to be the best for the selling side of the equation. In case you didn't know, that is, again, a really commonly mistaken piece. And I'm actually really curious. I'm going to have ChatGPT build a column for us really quick. So create in, oh, I think, is this custom already? I wanted to show you the difference between implied volatility. Yeah, so this is implied volatility rank, which is incorrect. So create a column for think or swim watch list that calculates the implied volatility percentile. So I'll show you really, really quick. We got to find a blank custom. Do we have any left? Damn, we're like on our last one. Nuts. All I'm doing right now is having Thinkorswim make a quick script. This is good. Uh, this looks a little excessive, but I'll show you guys what it came up with. So it really doesn't need this stuff. We don't need an actual plot. And let's just drop this in really quick. I just want to compare these so that you can see the difference between a calculated implied volatility percentile. So these look the same. So this is using the built-in implied volatility percentile versus actually calculating it. So the way that we would fix that is simple. What we would do is grab the calculation for implied volatility percentile from here and essentially say, use this. But I won't waste your guys' time going through all there. I just wanted you to at least understand a little bit of the difference between implied volatility percentile, implied volatility rank, and unfortunately, the fact that a lot of platforms mess them up. All right, let's get back to the quiz. The next question is, if you want to go long and underline, how do you choose between buying a call, buying stock, versus going, synthetic long? So in the chat, I want you to just overview how you would make the decision between putting on these different positions. What would make you lean between these? Kirk says time horizon, leverage, cost. That's solid. I think that's a really, really good way to think of it. Lauren says depends on portfolio and risk tolerance. I agree. I think that one's a little too open to get credit, but I think that's a fair overall concept for sure. Reese says depends, duration, severity. Sort of. Again, I actually think Kirk has a really good answer. Brain says IV. That's a good guess. I absolutely would consider that to be part of the equation. Mamba says capital efficiency, risk tolerance, and implied vol. I think of those, risk tolerance again would inherently apply to kind of all of them in terms of like you can make them the same amount of risk if you were so inclined. So I think your answer of leverage in IV is correct. Goofy says, I like going for some leverage if I'm optimistic for the next 18 months. Leaps are better than equity for my risk. Well, I wouldn't think of it necessarily that way either, just because you start to silo yourself in a little bit more than necessary. I wouldn't just kind of say like carte blanche leaps are better for my risk. I would think of it more so in terms of like what fits the opportunity that you're looking at the best. So let's think about it. Okay, so oh, I don't know how to say that. Okinano? Okanano says liquidity of options versus underlying. That's a massively important input. If we think about the differences between these positions, right? Buying stock is expensive, but if you buy stock, you do not have to worry about some sort of expiration. That doesn't matter too much because if you have like a solid P&L management plan, the expiration factor is generally secondary. But that's really the main benefit to holding the equity. And exactly as Wheelstrat Joe points out, if there is a dividend, you collect the dividend, which is also a completely viable point. If we buy a call, there's a lot of things we can do to decrease the impact from things like vol. We can decrease the impact from things like theta decay, but there's still an element of those. The other thing is you can set these up to have very, very different risk to reward profiles based on what you expect to see. The purpose of a synthetic long is effectively to take a levered stock position. Like that's kind of it. Because what you're attempting to accomplish with the synthetic long is to neutralize the Greeks. And you wouldn't want the Greeks themselves to derail a position if you don't have some sort of opinion on things like implied volatility. Because, like I was saying before in the covered call example and in the straddle, volatility absolutely has an impact. And it doesn't necessarily mean that it's the primary part of the decision cycle, but it does mean that you have to still incorporate some sort of opinion with respect to vol. So let's hold on. Let me get caught up on the chat. Brain says intention of the strategy. I think that's completely fair. Mamba says synthetic long best when implied volatility is high. By selling the put, you finance the call. I actually disagree. I wouldn't look at it that way because just like we talked about in this scenario, it really comes down to price movement. So with the levered long position, you decrease how much money you actually can make. Let's take a look at an example here in Wolf. And let's take a look at going a synthetic long at 50 days out. It does have high vol, so we should expect to collect a small credit because of put skew. We do. We get a 41-cent credit, which is actually nice. This is your risk profile. Let's take a look comparatively at a couple options positions. Let's take a look at just getting the call. And then let's take a look at getting an out of the money call, like a 20 delta. And then let's take a look at one more, and we'll look at a 30 delta. Okay, so let's take a look at these different scenarios. And I'm going to grab this so that we can track them together. So we're looking at a plus 5%, a 10%, 15%, and we'll do like a 25% move. So this is what we're going to track. And we're going to do this for a few underlines. I'll zoom this in for you guys so that you can see better. We're going to do this for long stock, a synthetic long. We'll do this for a 50 delta call, and we'll do this for a 20 delta call. And I'm going to move this off to the side so that I can fill it in a little bit quicker. What I want to do is, again, give you context. And I'm just focusing on the upside in this scenario because it's a little bit quicker. So the long stock, if you get your favorable move, you get 77 bucks. If you get your 10% move, you make 154 bucks. If you get your 15% move, you get 232. I'm just going to stop it at 15% because I think the point will be clear within these ranges. Now let's take a look at our synthetic long. The synthetic long is 77. 10% is 155, and then 233. The 50 delta call I have too many. I got tripped up. So it's 50 delta. Oh, okay, because we did a 30 delta as well. So I'll add the 30 delta to 30. Okay. So our 50 delta call, you're going to make 39, 86, 138. Your 30 delta call, and again, we're going to have to add a margin requirement part to this as well, because that's really where you're going to see the leverage expressed. So let me add a column for margin rec. Okay. So for the stock position, you're buying 100 shares at 15.52, so you're going to put up 15.50. The synthetic long, you're going to put up 1,600. This is in a contributory IRA account. So that means that that put is cash secured. If the put wasn't cash secured, if you guys can let me know what the short put requirement would be, then I can figure out what the margin would be for like a for a Reg T account. So if one of you guys could take a look at what the 16 Jan 16 put is, 16 strike put is in terms of margin requirement, I can update that. But right now it's cash secured. Next, we have the 50 delta. The 50 delta is 216 bucks. Next, we have the 30 delta call. Our 30 delta call is here. So this is going to be 94 bucks. In a 5% move, you're going to make 23, 52, and 85. And then the last one, the 20 delta call, which is going to be at the 22 strike. Those are going to be 64 bucks. And you're going to make 15, 37, 63. Okay. So we have Kirk says 1356. Thank you very much. That's for margin account, so 1356. Thank you very much. I appreciate that. So let's take a look at what these do. So you can see a difference in the gross amount, obviously, and it's because in order to put up this account or this amount of money, you're having to tie up quite a bit more. So all I'm going to do now is take these and turn these into percent returns so that you can analyze and normalize what the return on invested capital is. Why is that putting the dollar sign after? The fuck is that? It's weird as shit. Bizarre. Anyways, let's continue our little plot. Now you can make a logical comparison. The way you make a logical comparison between these is we get a sense of where the greatest return on invested capital is. And to no big surprise, you can kind of clearly see where that lives. So going back to the point that started this whole thing talking about a synthetic long. The issue with the synthetic long when vol is high is you're optimizing for the wrong thing. It's because more of the decision should come down to what is your expectation versus what you think is going to happen. Um, Black Mamba says, so it's riskier, mimics holding the stock when it's going down. There's a huge but. We work credit or zero. If so, that's your only bet. Yeah, again, the issue with it is that it's just the broader point that I'm making is that it's optimizing for the wrong thing. Because the original statement that you made was like, if vol is high, default or choose, lean towards whatever, a synthetic long. My argument is that while that's a completely viable consideration to make, if you get the move that you think, or depending on what the move is that you think you're going to get, it really should be based more on what is the risk profile that you want to extract. So even if the margin requirement for this wasn't 1356, I'll take a look really quick in a because I have a portfolio margin account. I'll tell you what it is in a portfolio margin account. I'm just using my phone to grab that super fast. And by super fast, I mean as slow as humanly possible. All right, let's go to Wolf. In Wolf, if I go out to 16 Jan and I look at what were we talking about? The 16 put, and I sell that. In a portfolio margin account, it's 244 bucks. So let's say your margin requirement is there. That can massively, massively change things. But again, one of the important factors is that for the same price for these, you can put on multiple of these other ones. So the reason why that matters is depending on what the pricing is that you can get. If you're in a regulation T account, it's really nothing that magical. Mama says at the end of the day, it depends on the move and how it looks. Yeah, that's exactly correct. So, and I think that's the most important point, right? Is that it actually doesn't really come down to volatility. And because if volatility is high, but you still get a big enough move, you can still make way more money with the long calls if you get the move, which is that's the big if, right? Do you get the move? The other thing to keep in mind is that you're actually going to have less risk on the long calls. The reason why you're going to have less risk is because you're taking on more types of risk. You're taking on theta now, but the total risk that you're putting up is definitely going to be decreased. And that's because if the thing starts moving against you, your deltas are going to contract. So then you're losing less per dollar of move, and obviously it will continue to slow. So, really, really good scenario to work through together and leads into a beautiful follow up, which you guys should definitely know the answer after what we just went through, which is which option provides you more leverage? A 15 delta call, A, or an 80 delta call, B. So you just throw in the chat if you think 15 delta or 80 delta, A or B respectively. So I see 3 A's so far. Okay. Does anybody think B? I see not. So my guess is you guys inherently know. Lauren, you think B? Is that correct? Brain says maybe B. Okay. So, Lauren, can you explain to me why you think it's B? Let's explore what that scenario might look like. Let's use Wolf as an example, and let's grab an 80 delta call. So the 80 delta call, we're going to get that for 430. and you're going to get that for 430. And I'm going to move these so that we can take a quick look at how that 80 delta call is. So 5% move, you get 60, 126, 195. Oops. 6. And I'll bring this back over so that you guys can see. Let's take a look. All right. So, Lauren, I don't see your logic in case you threw it in, just in case. I wanted to give you a chance to share what you were thinking so that we could explore the idea. But the answer is A. The out of the money option provides you more leverage. This has everything to do with convexity. So if we're comparing an 80 delta, I'm just going to use 20 delta here because it's close enough. You can see that the return on invested capital is more for the 20 delta effectively across the entire board. And it's also much cheaper. So what's going on here with these options that are out of the money is you're really playing the expansion of delta, which is tracked via gamma. Here's the way to think about it. If we take a look at the options chain, and let's just take a look at what your delta might become as the underlying moves. Because remember, once you have a delta of 1, you move dollar for dollar with the underlying. So if you have an 80 delta option, and let's draw a plot of its delta. And let's say that this is where 80 is. And let's say that this is underlying going up. Your 80 delta option can effectively go up to a 1 delta or 100 delta. This is the compounding distance that effectively you get before your option is simply behaving like a levered long position, moving 1 for 1. Whereas if you have that 15 delta option, and let's say 15 delta is down here, and again, let's say that your 1 delta is up here. In this scenario, again, if price goes up, you have a completely different compounding profile. So your compounding window increases to this. So you can see this total distance compared to this total distance. This is exactly why your 15 delta option provides you way more leverage. It's because this 15 delta option has a significantly further runway for its delta to grow and compound. There is exactly why there's more leverage here than here. Now there's a trade-off. Just as Black Mamba says the 15 delta has higher leverage, but a lower probability of profit, which is actually fundamentally inaccurate. What he's referring to is at expiration, which again is one of the things that's super important to understand the difference, especially as more nuanced traders, to be able to decipher the difference between something that's before expiration versus at expiration. Because in Black Mama's defense, that's exactly correct at expiration. However, it's not necessarily the case prior to expiration. Kirk says the 80 delta is better leveraged in slower drift moves because as it's leveraged relative to cost, but doesn't have the extrinsic value decay. That I wouldn't confuse those, Kirk. That doesn't mean it has better leverage. It doesn't have better leverage. It in again in your defense, in the example that you're using, it does most certainly mean that it might behave better, and I think that that's okay. It might be a better position in that scenario. I think that's okay to say, but very, very different. Black Mamba says, yeah, refer to at expiration. Yeah, and that's kind of the trick, right? Because when we're talking about probability of profit, basing the decision or basing the analysis off of expiration is a really common mistake. And it's because the option obviously looks different before expiration. So if we made our positioning decisions off of at expiration, especially if we have some sort of management plan that would lead us to manage before expiration, then we're kind of making a completely lopsided analysis that in general we would want to avoid. Kirk says better as in more profitable relative to 15 delta in slower drift moves. Yeah, yep. So we're definitely on the same page in terms of the potential profitability. I think the nuance here is that I'm just correcting the use of leverage. Just because it's more profitable doesn't mean it has more leverage. Another great example of this is we could just replace the 80 delta option with long stock. If the underlying moves up $1, but 20 days pass, the long stock unequivocally would make more money than the 20 delta call. However, that does not mean that the long stock has more leverage. It most certainly doesn't. And again, the reason why that point is really important to consider is because when you're building a portfolio, understanding the relationship of your positions and how they behave is really, really important so that you can build something that ultimately reflects what you're thinking of. So Brain says delta times spot divided by option gives you your leverage factor, more or less. Uh, mm, mm, sure. I think I wouldn't do it that way, but they're like that's close enough. I don't think that that's inherently wrong, but I think it misses and probably is confusing the point again in terms of like what leverage is. Black Mama says this delta that we see on chain reflects the real-time probability of expiring in the money. It's a great question. And the reality is the short answer is it genuinely does depend. It's a really, really commonly confused topic. So I'm going to link to a video for you to check out. Black Mama, this video is for you. And that explores the relationship of delta as a probability measure versus the actual calculation for a probability measure. The short answer is it's not. The long answer is there are circumstances where delta performs absolutely fine as a probabilistic calculation. That said, there's a lot of nuance in terms of you need to use, if you use it in that way, it has to be done with options that have lower volatility, meaning the underlying has lower volatility, and it needs to be done closer in time. So let's take a look at an example. This right here, this is a 48 delta. If we use this 48 delta, that would lead us to believe that this 48 delta option has a 48% probability of expiring in the money. If we look at the actual probability calculation, it's only 34%. So you literally have a 14% variance between using delta and the actual probability calculation. That is everything to do with volatility, and it has everything to do with duration. So because this popped up in a high volatility scan, that's why you see that so far off for this distance. Let's take a look at SPY really quick. If we look at SPY, same expiration, we'll get close to, we have a, well, let's use this 46 delta that's closer. So this is a 46 delta. We would infer 46% probability of expiring in the money, and it's 44 and a half. So call it 45. That's pretty damn close. That's because we're not too far out in time, and we're looking in SPY, which is much lower vol. So the way to think about it is, in general, you're just way better off using the actual probability calculation. There's no real reason to use delta. If you're in some sort of scenario where you have to use like a back of the napkin and you have to use delta, or you have access to delta for your calculation, like, you can get by, because all you need to do is add like a mental deflator to it. But other than it being a really lame party trick, there's really no use to like using delta versus the actual probability calculation. So to summarize all of that, I would absolutely just use the probability calculations, because the other stuff that gets messed up is the probability of a touch, where people would infer that it's 2 times delta, which that also breaks down quite a bit. So it's a great question. I hope that that helps. If you have any follow-ups, let me know. Okay, last quiz question. What is the most important aspect of a strategy to get right? Your days to expiration, which is A, the option structure that you use in order to monetize the idea, which is B, or your profit mechanism, which is C. What do you guys think the answer is, A, B, or C? I see 1 vote for C, 2 votes for C. Any other votes? I see another one for C. Good. Does anybody think something other than C? Kirk says B. Kirk, can you explain B? Why you think it's B? Mamba says C. Good. So the answer here by far is C. The most important aspect of a strategy is the profit mechanism. But I want to explore with Kirk what he was thinking behind B. Kirk says, devil's advocate, you can get the profit mechanism right, but use the wrong options to profit from it. Yep, definitely. The more important factor, though, is that you can use the correct option structure for the wrong profit mechanism and lose money. So the same logic that's being applied to C in that scenario would apply to B. It's not wrong, but like your original answer of B, the reason why option structure is incorrect in this scenario and profit mechanism is correct is actually for the same reason but inverted. Let's take a look at a scenario where we think this stock is going to go up. Let's say that it just had a breakout here, and let's say that it was on strong volume compared to the other days. We think it's going to go up. So we have a upward bias. For this upward bias, it doesn't really matter if we go synthetic long, if we go long equity, if we go some sort of long call with some duration on it. You can buy a long call that loses money. So the strategy or the option structure still matters. It's not like which one of these doesn't matter. They all matter. But it's what matters the most. Because if you understand the profit mechanism here of a breakout, and you understand the profile of a breakout, which is, over the next 6 days, you expect it to move at least 2 times the prior reference period. So let's say that the, the consolidation period itself was a total range of 6%. So over the next 6 days, you expect it to move at least 12%. These details help you pick the structure that best fits this idea, inherently so. And most importantly, is that if your profit mechanism is correct, you still would make money in effectively all of these scenarios. It just because it becomes a game of like how much money. So this is why profit mechanism is such a critical component of a strategy. It's literally the base of any strategy. And that is because if you get your profit mechanism correct, you can literally get everything else correct. So if we look at the outlier strategy process, your very first step is to create a profile for your profit mechanism. This is when we're talking about an option strategy. Notice how the concept of structures doesn't even come into play until step 3. Doesn't even get into the equation until here. And it's because you have to understand the profit mechanism quite deeply, which is actually a beautiful preamble to the second thing that I said that we were going to cover on the stream tonight, which is where to go from here. I'm working on a new video that's going to come out hopefully in the next, well, it's not going to come out for a little while because I have a backlog of videos, but I'm hopefully going to make it in the next couple weeks. And the concept of the video is to take pretty much all of the primary trading processes and to list them out so that we have a comprehensive understanding of what all of the major processes are that go into trading. The way that I would think about devising your next steps, depending on where you're at in your path, is the first thing I would do is focus on outlining what you believe the major processes are that you need to nail down as a trader. So let's just spitball some of them. One of those processes, for sure, is fundamental knowledge. Fund knowledge. And the purpose of this is to build your baseline understanding of the tools that you're using. So a great part of this process is literally attending the Friday beginner series, right? Like that is a way to hone your fundamental knowledge. The other stuff that applies here are things like creating a feedback loop for your learning. So let's say that you dedicate 5 hours a week to fundamental knowledge education of markets via a split between books, podcasts, YouTube videos, whatever. And then once a week, you have AI quiz you. That's a great way to build a quick and easy, but very usable fundamental knowledge process. Another process that that you need to come up with is a strategy process. And I already have a video that talks about this. We just looked at the outline for the video, but this is how you actually build stuff. Now, there's a really big granted step in the strategy process, which is the profit mechanism profiling. You have to develop a process to profile profit mechanisms. You have to have a process for this. The reason is it's very easy to get completely misled when you're looking at stuff. So for example, if you're looking for a new strategy and your approach to finding a new strategy revolves around like going on YouTube and typing in like option strategy, that's not going to work well. That's just the reality of it. you're not going to find a ton of like gold there. The stuff that I share are things that are robust, but I'm not sharing like any of my like really detailed, nuanced stuff on fucking YouTube. And why would I? The stuff that I'm sharing on YouTube are like the base concepts that work well, that are in things that are, again, well known. So I'm not sacrificing any of my edge by explaining different ways to trade a covered strangle in index ETFs, right? Like that doesn't eat any of my lunch at all. But some of the more advanced stuff that I do, a great example of this is a trade that I made a couple of years ago, which was the absolute most profitable trade on the account as a percentage basis in my entire trading career. And it took place over 2 days. There's no content out there about that trade, and there won't be any content out there about that trade because I'm not going to share it because I'm still looking for it. What I'm trying to impress upon you is that you have to develop a methodology to research profit mechanisms. And if your methodology revolves around just like going on YouTube and seeing what you can find there, there's a huge, huge, huge gap in that process. And you need to take the time to iron it in, or I guess iron it out. This is the first step of your next steps after this series is to outline the different processes that you think you need to develop in order to support your broader trading. After that, the next hands down most important thing is to find a way to get external audits. The reason for the external audits is when you're learning something, you absolutely do not know what you do not know. So if your approach is going to be based on you thinking, you'll be able to do what you want and then magically make money doing it, and you're not going to slip up or have different mistakes along the way, you really are in a heavily disadvantaged position. Because again, the probability of you being able to identify all of the different gaps in what you're doing is very low. It's super, super low. So the last thing to think about is how do you develop a methodology to have an audit? This can be meeting a friend from one of these streams that you sync up with once a week, and you explain what you've been working on, and you try to poke holes in what you're doing, and so on and so forth. These, I think, are the definite like near-term focus steps for everybody in the series. This one is most important, which is outlining the different processes that you need to have. And then beyond that, it's creating some sort of methodology for auditing. And you have to have an audit process that can be done via ChatGPT, right? Like you can absolutely use whatever is at your disposal, and you should. The trick there is it needs to be something that can catch your blind spots. Okay, so we're now going to pivot the last 15 minutes or so into just an open dialogue. But before we pivot into an open dialogue, I just want to check to see if there's any questions on anything that we went over, at least in the session today. So anything from the quiz or anything from what you should be focusing on for your next steps. Anything in there. And if so, now's the perfect time to throw that in. If not, now is the perfect time to share any broader topics that you want to talk about. We can cover anything that you think is relevant. So it can be stuff related to trading, it can be stuff not trading related, whatever you want to explore. There's a couple things that are on the top of my mind, depending on what you guys bring up. I actually want to give you an opportunity to bring up stuff first, but I have a few things that I want to discuss broadly, anyways. So fire away if you have anything. The things that I think, at least at this point, that would make a lot of sense for you guys to be thinking through is like w- when you make this approach and you move into attempting to trade for a living, there's a lot that goes into that. And I think most people don't really go through the planning process well enough. So I want to talk about that. But let me see. Brain says I placed a double diagonal on BABA for earnings for a $2.45 credit up front. I closed it the next day for a 23 debit, 93% gain. I have no idea how it worked. What were the expirations for the diagonal? And where did you have the long and short legs relative to one another? Because realistically speaking, there's probably two big things that went down in that scenario for you. The first thing, obviously, is the earnings move. The second thing is any sort of follow on price behavior. So if we take a look at BABA, BABA kind of just sat. So the biggest thing that you had there working in your favor is the fact that volatility contracted as much as it did. If you didn't get that kind of vol contraction, then you really wouldn't have much to show for it. That's the biggest reason why you saw something go down there. Let's talk anything else on that brain before we look at anything else. Brain says front expiry expired that week, long strikes December, monthly expected move wide. Yeah. So the reason why is because of vol. The long strikes out in December didn't really realize much of a change in vol because they're so far out, and the majority of that profit came from the short options in the front effectively expiring and by being within range. So yeah, that's exactly what you had going on there. Those kind of trades are also interesting, and I think in general, those kind of trades can work really, really well. But I also think in general, those are not necessarily getting you the direct exposure that you want to the effect. Yeah, but that's exactly why you saw that move that you did there. Anything else that you guys want to work through? I want to talk a little bit about planning then, and again, like feel free to throw in anything as we go through this. But before you start going super far down the rabbit hole of like trading, I think it makes a lot of sense to conduct a general planning process. And the purpose of the planning process is to give you some sort of frameworks to work off of as you're learning. So we just explained a bunch of different things that you have to outline for your homework next. And as you're doing that, I highly recommend sharing it in the Discord. It's free for everybody to join. And most importantly, it's a good place to get feedback from people and to share ideas. the main idea here is you have to balance a few things. You have to learn. So this is a one-sided item that you have to do. The next thing along learning, you have to figure out your execution approach. The way that you're going to execute will evolve as you're learning, and then your execution needs to be based on your goals. So when you're before you get too far into learning and before you get too far into the execution phase, you have to develop solid goals, and I'll explain that in a second. Black Mama says, Eric, when do you prefer leaps? I got leaps this dip in Meta, in Tesla. I'm diversifying stocks to. It's easier to sell the leaps than good stocks. So leaps for me typically are when I want to have some sort of levered position in an underlying. I actually am trading leaps way less than I used to. And it's because a lot of my trading methodology has come in time quite a lot. And the duration that I'm holding these trades is quite a bit lower. So my need to go out and to get leaps is decreased. And it's also a liquidity factor. So if we take a look, for example, in BABA, and we just eyeball what the liquidity looks like across these different time frames. If we go out, let's say like 80, 90 days, somewhere in here, you're about 50 cents wide for at the money. And then if we go out, let's say to 15 Jan 27, you can see that you're like $2.15 wide at the money. That liquidity factor becomes a bit of an issue, especially when you're trading at size. So I find in general, I don't actually like to go into leaps quite as much because most of the stuff that I'm trading, I'm not holding into perpetuity. And you sacrifice a lot of liquidity for options that you can scrub away, things like theta impact more easily. So that's the base thought process, at least towards leaps. I would prefer like most of my longs based on my trading approach. Like if I'm trading ratio call diagonals or stuff to the upside that way, more often than not, I'm like 60 to 120 days out, something like that. Reese says Pareto principle. My gains have come from core holdings. Basically, when trading, just the chart, my results are meh. So I've been leaning more into investor like who likes options. That's okay. And I think in your scenario, Reese, one of the things to consider there is like probably a gap in your profit mechanism research. Because if you're trading based on the chart, that isn't inherently bad, but it does require research to figure out like how you want to trade the chart and what makes sense. And from that lens, if you do a good amount of research, you can trade absolutely successfully that general way. But if you don't do the corresponding research, it's really, really difficult to trade that kind of methodology with any conviction. So if you find that it's more effective for you to invest and use options for leverage or whatever, like I think that's completely fine. The main note there is I wouldn't write off options or that trading methodology that you're doing until you've done enough research to then objectively say like whether or not it should be exonerated. Black Mom says, I want the shares, so I did a huge hit I will exercise the shares, kind of the opposite of cash secure put. Like, hold on, what? I want the shares, so I'd get a huge hit if, wait, I will exercise the shares. Well, the thing is like if you have leaps, you don't want to exercise them. Like that, I hope you already know, because you're going to give up an insane amount of extrinsic value. You will be light years better off just if I get a huge hit. Oh, I see. I want the shares, so if I get a huge hit, I will exercise the shares. That's a massive mistake. The reason is, regardless of how big of a hit is that you get, you still are giving up a ton of extrinsic value that you otherwise can capture by literally just selling the options and then buying the shares. There's absolutely no benefit to exercising your call early, other than like the vanity metric of liking the basis that you see better. But you're not giving up any profit because you're realizing that profit that you would have on the basis otherwise. So here's effectively how that would work. If we look at another scenario here, and let's take a look at a deep in the money option. We're just in BABA, so I'll stay here. And let's go to 15 Jan 27. And let's say that you have the 100s. And let's say that you got them for 65.10. It doesn't matter what the price is. So 65.10 is your 100 strike calls. The underlying right now is at 157.30. If we look at this scenario, we can easily see how far in the money your option is, so we can break down your value. So you'll have intrinsic, and then you'll have extrinsic value in this option. Your intrinsic value is simply how far in the money your option is. So in this case, your option is 57 points in the money. We don't want a percentage here, we want a dollar. So that's your intrinsic value. I think I flipped them, sorry. Oh no, we just have to multiply it out. Your extrinsic value is the remainder. So this minus this, that's how far in the money you are, which is 57.30. And then your difference here is your extrinsic, which is 785. I just had them flipped. The issue is if I exercise my option, let's say the 100, what happens? That means I'm going to buy to open 100 shares at $100. So the total amount of money that I'm going to have to put out is 10 grand. And the current unrealized P&L here is literally just your intrinsic value. So it's how far in the money you are times your size. That's your unrealized P&L. Let's take a look at what happens if instead you sell your option. Again, depending on whatever you bought your option for P&L, we don't know yet. But if you sell to close your option, what you're doing is you're getting 65.15. Notice the difference in the P&L here. If I literally sell to close my option, I'm getting 65.15. If I exercise my option, I'm switching to an unrealized gain of 57.30 and I'm getting rid of all of my extrinsic value. So if I really wanted the shares for some reason, I would be light years better off literally selling to close the option and then buying to open the shares at spot price, whatever that is. And it's because of the extrinsic value. When you exercise early, you get rid of this, which you do not want to do. There's just no good reason to get rid of the extrinsic value. It's literally just throwing it away. There's no benefit to doing it whatsoever, which is exactly why early exercise is so rare. You just don't see it that much. So that is why that's typically not a good reason. All right, gang. Absolutely awesome hanging out. I hope you guys enjoyed the mini series. If you did, please feel free to share it with folks that are going through their learning process. I try to do these to help folks. So you guys can help me do that by doing that. And I will be traveling tomorrow, so not doing any streams. And then we'll be back on scheduled program come Sunday. So enjoy the rest of your weekend. Be an outlier. See you guys later.